Hello and welcome to Markets in Focus. My name is Joe Bell, and today we're going to talk about the most interesting financial themes that I'm observing. Number one, Americans are moving again. We're looking at data from the Fed and the airports, and they're both saying the same thing. Number two, everybody's been talking about interest rates. Let's discuss why technology and growth stocks tend to struggle during these periods historically. And number three, looking back at the 1 year anniversary, we just passed it on March 23rd of this recovery. Let's take a look at what parts of the market have outperformed and what we might expect in year two. And so the Dallas Fed Mobility and Engagement Index, what is that? All right, it's basically an index that is comprised of 7 different variables based on tracking data from mobile devices. I have no idea how they get this data, but they have it and they're basically tracking us. And what they're telling us is that we are moving the most that we have since March of 2020. Now, data from the TSA is saying the same thing. If they track the total number of people that are going through TSA checkpoints each day, and on this chart, we have the blue line is a 5-day moving average of that data. And we can see here that it is dramatically improving. Now, if you compare that to the gold line, that's basically a look back at each respective day 1 year prior, basically that 2019, early 2020 period before any of this pandemic happened. We're not necessarily back to normal, but you can see that we're trending in the right direction. I think the optimism around the vaccine, sort of that optimism around the reopening, some of the stimulus, I think all of it together is leading to optimism for the common American. So rising rates caught a lot of headlines, the speed and magnitude in which the 10-year yield has risen recently. If we look back to 2013, we had a somewhat similar period where the 10-year yield increased from 1.6% all the way to 3% in just a 4-month period. And what's interesting is it's very similar to what's happening now. You saw technology participate, but it was actually the biggest laggard during this period. We all know what happened next. Obviously, interest rates settled down and eventually resolved themselves lower, and technology took a leadership role for years. Now, growth stocks, like technology stocks, tend to struggle during these periods, and the reason is twofold. Number one, as a growth stock, they're obviously investing in a lot of new projects and initiatives. Those are going to cost more when interest rates go higher. And number two, as analysts are valuing these companies, if you're looking at big future cash flows down the line, they're going to discount those back at the current market rate. Higher rate means lower valuation. So all else being equal, higher rates, not too good for growth stocks, which technology names tend to be historically. And finally, let's compare and contrast today's recovery to the 2009 recovery, which, if you look in terms of magnitude, these are two of the strongest recoveries, and they're very similar in another way. Look at the 4 different categories here. We have stocks versus bonds, high versus low beta, copper versus gold, and small versus large cap. Those are all risky versus less risky, right? And basically it's pretty consistent. The riskiest parts of the market outperformed pretty significantly in both recoveries during year one. Now, year two, we haven't had this time, but year two of 2009, what did we learn? We learned that year two doesn't slow down necessarily. Does not reverse and go completely to the downside. Momentum still continues, but it slows, and it slows in those pockets of the market. You can see they're not necessarily reversals, right? They're not all negative, but they're dramatically lower. So I think if history is a lesson, it tells us, hey, these areas aren't going to do poorly, but this magnitude of their outperformance is probably going to slow if we see anything like we saw in 2009, 2010. And now we like to end with a fun story. This one's not so much fun. It's more interesting, though. Someone had a pretty bad day at the job. All right. There's a large canal, one of the largest, Suez Canal in Egypt, 120 miles long. About 2% of global GDP goes through that canal each day. The Evergreen cargo ship, over 200,000 tons, was stuck on the side between the water and the land there. Not sure if it was a combination of wind or technical or human error. They're still investigating. But more than 450 ships behind it were stuck for almost a week. Estimates that there may be a loss of more than $10 billion per day toward global GDP and about $15 million in revenue per day for the canal. Some of us might have had a bad day when we were trying to rush because we were late and getting a speeding ticket. I think this snafu is a whole nother level. This is after the investigation, someone's going to probably have a bad year. All right. With that, I want to thank everyone for watching, and we will see you next time.